Well, happy Monday. I wanted to talk to you today about the effect of all this craziness in the markets with bank closures, et cetera, and what effect that's having on mortgage rates and mortgage-backed securities. Okay, so let's dive right in. So the chart I'm showing you here is the 10-year Treasury. This reflects the primary flight to safety of investors. So large institutional investors like mutual funds or pension funds or foreign countries that invest, they go here when things are crazy. So this 10-year and other bonds, but particularly the 10-year, is a primary flight to safety mechanism for these large investors to protect their money. So we've seen a major move down in yields. You can see that, right? Just since the beginning of March, just in the last week and a half, 2 weeks, what a drop. It's been really, really amazing. Actually, if you're in the financial markets watching this, you're like, wow, that was that was a quick move from a little above 4%, down to 3.5 range. Huge move in a short period of time. So why is that? This is a reaction, of course, to the Federal Reserve raising interest rates to try to control inflation, but raising them too fast in too short a period of time. When you do that sort of thing and don't give the economy enough time to absorb those changes, you break things. The Federal Reserve is breaking things. You probably saw that in the news over the past week and a half with SVB Bank and other banks, and now Credit Suisse overseas, collapsing under the weight of really the lack of confidence of depositors in the banks, because the banks probably likely overinvested in a number of things that were too risky, including overinvesting in mortgage-backed securities was part of what they did back when rates were at 2-3%, right? And they didn't have any counter strategy to compensate for a rate increase of this magnitude by the Federal Reserve, which just wipes out the long-term value of those bonds. Now, wouldn't affect a bank if they didn't have to mark to market. In other words, if they didn't have to show the loss on paper because they were going to hold those to maturity, it wouldn't affect them and their balance sheet. But these banks that were teetering anyway because of other issues, like SVB Bank, had to mark to market a lot of these MBS securities and other treasuries that they'd purchased back when rates were really low, which showed a huge loss on their balance sheet, which eroded investor confidence and patron confidence in their bank even further. Pulled money out, you had an old-fashioned run on the bank, right? That's basically what's happened with these few things. So think It's a Wonderful Life. Go watch that movie. That's essentially what happened. SVB Bank on a slightly larger scale, but it's quite the deal, quite the show out there. So how is this affecting all this uncertainty that's in the marketplace around financial institutions? How does that affect mortgage-backed securities? Well, let me get to that chart. You've heard me say over the years that I feel like I'm in the funeral business, right? Sometimes when there's negative news, many times when there's negative news, whether it's economic or even political, it affects and benefits interest rates. So we've seen the same thing happen. Here's the MBS chart. So this is mortgage-backed securities, your 30-year fixed mortgage bond. Going back 3 months, you can see we're back basically to the levels we were at near the beginning of February now. And this is price, so it's the opposite of what I was just showing you. The 10-year Treasury shows you yield. This is price, so it's in an inverse relationship here. So you've seen the price rise pretty dramatically, although not quite as much in proportion to the 10-year Treasury. The 10-year Treasury has dropped more than the MBS has risen, but we will catch up over time. Now, some of this rise, of course, has been fueled by like this date right here, March 10th. That was the employment report a week ago Friday that came in a little bit more favorably than expected. And then the next week, we had the CPI report and then the PPI report here. So that's helped because inflation isn't rising as fast as it was. So the year-over-year numbers are coming down. But again, we need a Federal Reserve to slow down a bit on trying to fix things so fast that they don't break more things in the economy. That's really what is this concern and this contagion right now with the smaller banks is causing. So let's see what happens. Jerome Powell is supposed to speak this week. Hopefully, he doesn't say anything too crazy, and we can move forward. And see some continued improvements in mortgage-backed security pricing. Today, of course, we've seen a little bit of weakening, but as you can see, it's a seesaw. So we are recommending to those that are trying to close and purchase a loan, purchase a home here in the next 30 days or less, to lock in an interest rate. So if that's you, if you're looking at buying a house and you're under contract, I recommend locking it in. It is just a little too volatile for me to want to, stomach that, and it's best to sleep better at night, knowing that you know what your payment is, you know what to expect on a 30-year or 15-year fixed mortgage. That just is the prudent thing to do for you individually and your family. So that's my recommendation today. Have a wonderful week. Talk to you soon.